Deciding on the best property investment strategies for you can be a daunting task, especially if you're a first-time property investor. There's negative gearing, flipping, buying and holding, or even positive gearing. Which one do you choose? Hi everyone, my name is Tuan. I'm the founder of Tax Quantity Surveyors, here for another video designed to help you become a better property investor. There is no one-size-fits-all strategy when it comes to property investment strategies. I see a lot of investors, especially beginner investors, make the mistake of following the crowd. And what this usually means is that there are some pretty severe financial consequences if you don't know what you're getting yourself into. So, today, we're going to share a few of Australia's most popular investment strategies to help you pick the best investment path. Stick around until the end so that you don't miss out on any of the strategies that may work best for you. Before we get into it, we want to be clear that this video is for informational purposes only. In no way should you use this as tax advice. We always recommend working with a qualified accountant or tax agent who can give you the best advice for your situation. Number 1, purchasing your own home. One of Australia's most popular investment strategies simply involves buying a home in which you plan to mainly live in. This is called your principal place of residence, which means you treat the property as your own home for as long as you own it. Now, you don't immediately generate revenue from living in the property you buy. The two benefits of this property investment strategy are that, 1, your cost base is likely to considerably rise in value, especially if you do any renovations and or hold onto the property for an extended period. Number 2, if and when you decide to sell the property, you won't have to pay any capital gains tax. So this is how most Australians first get their foot into the property market. Number 2, buy and hold strategy. Probably the most simple strategy out of them all is the buy and hold strategy. Here, you're purchasing a property with the ultimate goal of holding onto it for long enough to generate capital growth. So you're buying it and simply leaving it to appreciate over time. But depending on the market conditions, you have to be prepared to at least wait 7 to 10 years before you realize any real capital growth. While waiting, most investors use the property to generate a rental income. The rental income can help cover some or all of those mortgage costs and comes with one significant benefit: investment property tax deductions. To find out more about the tax deductions you can claim, check out our video that covers 17 tax deductions that you can claim on your investment property. Number 3, the gearing strategies. In simple terms, gearing means you have borrowed money to buy your investment property. You can either negatively gear your property or positively gear your property. Negative gearing occurs when you borrow money to invest in property and the income you make from it through rent, for example, is less than your expenses. In other words, you're running at a loss. Running at a loss isn't an ideal situation, but it's not all that bad in Australian tax law. The Australian Tax Office allows property investors to deduct any losses they make on their investment property from their taxable income. Most investors use the negative gearing strategy in conjunction with the buy and hold strategy so that their rent can contribute to some of the property costs. At the same time, the investor waits to cash out on the property's long-term capital growth. Positive gearing, on the other hand, is the exact opposite. Having a positively geared property means that your investment property rental return is higher than your home loan repayments and other property costs. In other words, you are consistently making a profit from your investment property. So, as an example, let's say you buy a property for around $400,000. Your mortgage expense and other property costs end up at around $410 per week. If you manage to secure a tenant that pays you $520 a week, you'll not only be able to cover your property costs, but you'll also make a profit of $110 per week. That is positive gearing. Unfortunately, this does mean that you'll have to pay more tax because your income will increase. But remember, if you claim all your investment property tax deductions, you can reduce the amount of income tax you pay each year. One of these tax deductions is depreciation. The great thing about claiming a depreciation deduction is that it's a non-cash deduction, so investors don't need to spend any money to claim it. This can have a massive impact on your cash flow. Number 4, renovate and hold. Instead of just buying and holding your property, with this strategy you renovate it to maximize your property's earning potential and create what's called forced appreciation. The idea is that by renovating your property, you can increase the value and possibly increase your rental rate. So while you are waiting to realize a potential capital growth, you could earn higher rent to cover your property expenses. You may even be able to positively gear your property. It is a risky strategy though. There's no guarantee that renovating your property will increase your rental return. Even though you might plan as best as you can to lessen the risk, there is still a chance that your newly renovated property won't make more money than you spend. Not to mention, renovations will also allow you to claim depreciation. You can get in touch with a quantity surveyor like us to help you with a free assessment on how much you can claim. So make sure you do your research before renovating in an unfavorable rental market. Number 5, flipping. Not all property investors are interested in waiting years to see a profit from their investment. So instead, they search for old, run-down properties to renovate and quickly increase the sale value. This process is known as flipping. The benefit of this property investment strategy is that you can make a profit relatively quickly because most investors try to complete the entire process within 12 months. However, it is one of the property investment strategies that demands the most skill. A lot of planning has to go into ensuring that you accurately predict the potential of the renovation. You also risk spending more money than you budgeted for if you don't tightly monitor your costs. So this strategy is generally best suited for an experienced investor looking to expand his or her portfolio quickly. So there you have it, Australia's top 5 investment strategies. Remember, these aren't the only investment strategies, so make sure you do all of your research before committing to just one. The goal is to pick the right investment strategy for you that lines up with your current financial needs and your future financial goals. If you know a friend, colleague, or family member that needs to hear this, please make sure you share this video with them. If you got a lot of value from this video, check out our YouTube channel and subscribe for more. And make sure you click on the bell icon so that you get notified of the next video. I'm Tuan. I'm from Tax Quantity Surveyors. I'll see you next time.